Welcome back to the Bespoke series by Vendors Wealth. For those of you who are joining our webinar for the first time, Bespoke is an Vendors Wealth initiative, that just helps us engage with our clients on topics and themes that matter to them the most. I am Twisha Shah. I'm part of the Investment Solutions Group at Vendors Wealth. This is the third edition of our Bespoke webinar. And as you know, today's topic is going to focus on the who, what, and why of investing outside India. So over the last few months, I think there have been many key events that have sparked a lot of interest for our investors in the global markets. Until now, most of our investors have, focused on broad index-led investments. That also mainly in the US, and that also mainly through feeder funds available in India. However, as investors are becoming more and more savvy and the world is becoming a smaller place, there is an accelerated realization of the importance of geographical diversification in a more meaningful way. Whether it's the massive rise in the prices of the magnificent seven stocks in American markets, or the stimulus announcements in China, or the unwinding of the yen carry trade, all of these factors have, sparked a lot of interest and underscored this point further with our investors that geographical diversification is definitely warranted. This has also led to many questions from our investors. How do we invest? What are the various tools that are available to Indian investors to invest today? What are the vehicles that we can use to make our investments more efficient? Why is it important to diversify? So on and so forth. So the objective for today's webinar is to try and address some of these questions. I think that sets the context for today's webinar, and I'll just introduce the panelists that we have with us today. So first we have with us Ashwini Chopra. He heads the family office practice at Avendus Wealth. Ashwini brings over 3 decades of experience in family office management, trusteeship, private banking, and capital markets. He brings to the table years of practical experience in helping families and corporates in diversifying wealth abroad. We also have with us Saurabh Singhal, who heads our offshore investment desk at Avendus Wealth. He has over 15 years of experience in wealth and asset management. And for over 10 years, he's been working on the offshore investment side. We also have joining us today from Legacy Growth Partners, 2 external experts. So Legacy Growth is a global multi-family office boutique firm. So they're very well versed in addressing needs of larger families and family offices, and they have years of experience in addressing complexity involving family structures. From Legacy Growth, we have joining us today Suraj Malik, who is the founder and the managing partner, and Rupali Ashar, who's an associate partner. So as always, our aim will be to try and make this as interactive as possible. At the end, we will have a Q&A session. So we'll request our participants to type out the questions in the chat box available at the bottom of their screens. Just as a precursor, I will first hand it over to Saurabh. He will lay out the foundation of this webinar today, and with the various international opportunities that Indian investors should be tracking outside India. Saurabh, over to you.
Thanks, Trisha. Hi, everyone. Pleasure talking to everyone, and welcome to our webinar of investing outside India. I think the time is great because financial year is coming to an end, and the LRS limit, which allows us to invest outside our country, is also, expiring on March of 2025. So it's a yearly cycle which is expiring every financial year. So very exciting time, and I'm very excited to talk about global investments as part of portfolio allocation, which in our experience we have seen that there is very limited allocation that we see in our clients' portfolio at this point in time as far as global investments are concerned. And there are multiple reasons why we feel that global allocation should be part of clients' portfolio. I'll just lay out a couple of points why we feel it is important. First and foremost, which I think Tosha very well highlighted, is diversification. India, as an economy, we are growing. We are among the fastest emerging market economy. But there are other economies also across the world. They have edge over certain sectors. They have edge over certain technology, and it is always prudent to diversify portfolio across different geographies, so that if one geography, one country, one economy is not doing very well, at least there are baskets, there are pots in which portfolio is performing, so that it builds a great financial safety pot, which is immune to many things and also, helps in terms of diversification across different geographies, different countries. So diversification is the most important point that we feel that, offshore should be part of client's portfolio. Obviously, because of certain restriction, it anyways cannot be a large portion, but at least in terms of steps, in terms of allocation, it should be a part of every client's portfolio. So diversification is must, which is giving us not just country diversification, but also giving us diversification across different asset classes, different currencies, different uh, investment themes as well. So that's the most important. I think the chart or the slide simply lays out the context of different economies across the world, and India is obviously among the fastest growing economy. But yes, most of the money from the allocation standpoint or size and scale standpoint, we see a lot of money is going into US markets. A lot of money is going into Japan. A lot of money is also going into selective European markets as well. And hence the diversification is the key role, plays the key role in clients' portfolio. It also, helps bringing down the beta or the volatility or, in the portfolio as well. Another important point, which is covered in the next slide, is since India has capital controls, since we are dependent on import to a great extent, we see our currency depreciating between 3 to 4% year on year from the last 15 years, which means that our purchasing power is reducing. And a lot of expenses that we see, both personally and the businesses that we run, are in foreign currency. For example, the travel that we do, some of the shoppings that we do, uh, kids are going abroad, their expenses are in foreign currency. And also in terms of the businesses and the corporation that we are running, there are multiple expenses, both in terms of import, in terms of other heads. Those are incurred in foreign currency. But the revenue stream that we see are all uh, aligned in local currency, which is INR. Hence, there is a mismatch in terms of the revenue that we make or the income that we are making and the kind of expenses that we are making. And it is reducing our purchasing power every year by 3 to 4%. Hence, currency diversification should be part of the portfolio. And that is the second reason we feel that offshore allocation, irrespective which asset class, irrespective which country, geography, or sector that we want to play, but it has to be utilized for global allocation. So currency diversification is the second important point that we feel that should be part of, should be considered as far as global investing is concerned. And the limit that we have, which I'm sure my other colleagues and panelists will talk in greater detail in terms of how and in what structures money can be taken out. But for individual, the limit is extremely small, which is 250,000 US dollars per annum. Hence, and this includes everything, including travel investments. Hence, we feel that to create a decent pot, we need to inculcate this habit of remitting or utilizing the LRS limit every year. A part of it is anyways being utilized for travel purpose, but a part has to be used for investment purpose so that a safety pot, safety net can be created, which can be utilized in future in many ways. It can be utilized for buying property. It can be utilized for maybe expanding businesses, acquiring some business, or maybe setting up a new company outside. So there are multiple reasons which helps us in terms of creating this spot. And to buy property, maybe in Europe, maybe in Middle East, you need at least a couple of $1 million. And considering this small limit, we feel that safety pot creation of safety pot is the most important point. Next point is in terms of accessing some of the themes. Those are, just reflected on the slide that we're talking about. There are multiple themes. Those are playing a large role in shaping global economy. Some of these themes are available in India in a very fractured manner, but they are the themes across the world, and they are spread out across different geographies. Most of it is obviously are based in US, but there are many companies those are there in Korea. There are many companies those are there in small parts of Europe and in other Asian countries. So to play these new age industries, AI, deep tech, machine learning, we need to have allocation to global managers or maybe to global companies directly, which in India we uh, we may not get access to some of these things directly. Hence, we need to utilize our limits and start allocating capital outside. So this is the fourth point, why we feel that investing outside India is something should be part of every client's portfolio. And currently, while we review and we see our clients' portfolio, majority of the portfolio is anyway tilted towards emerging market. And if we have to just see some of the numbers, emerging market in the last 10 years have delivered around 6 to 7% return, annualized return. India specifically is under shade under 9, whereas some of the developed market like US has delivered about 14% dollar return. Even though the returns are higher, but because of the currency depreciation, they eat away some of the alpha that we are generating. So not that India is the only market which is generating return. There is money to be made in other in outside India in terms of developed market and other allocation, which we will, I think, speak in the next slide. Now, in terms of uh, how the money is being invested, as we've been tracking global investments and we've been advising our clients in terms of global investment, we see money is flowing into different asset classes, but predominantly, like we started the webinar with diversification, one of the simple and the most used instrument is the developed market and emerging market allocation, where we see a lot of money going. Another interesting basket where we see a lot of money going is fixed income space. And this is thanks to global inflation and global central banks. Yields are elevated at this point in time. And they are elevated for the simple reason, interest rates globally have been up. Central banks have been raising rates because of inflation, because of which the yields that we are able to target today are unprecedented in the last 15 years. So today it is possible to target high single digit uh, dollar return in a basket of bond portfolio. Whereas if I, just go back in the history 3, 5 years back, but the yields were anywhere between 300 basis points to 500 basis points. Now we are able to target anything which is 8 to 9%. So fixed income is attracting a lot of money, not just from India, but across the world. And we see Indians also, participating in that space in a big way. Another interesting play just to play out those new age tech companies is the global private equity space, because most of these companies, new age companies that we see on the cap table, they restrict who can come on the cap table. Hence, it is the best way to get access to some of these companies and founders is via some large manager. So we can secure an allocation, or we see clients allocating capital to managers. Those are sitting on the cap table on some of these large companies. So that is another way, and we feel it is a very important allocation as clients' portfolio, because to bring new age companies, tech, obviously, which is a long-term theme, should be part of the portfolio, and we have to play it via managers instead of playing some of these things directly. Hedge funds is the second basket where we see a lot of allocation going, for the simple reason, as we have seen in India, option volume or derivative volumes have gone multifold in India. And so is the case with global markets as well. Some of the high frequency trading firms, some of the medium frequency trading firms or quant firms are generating equity like return with very low volatility. Hence, they are attracting capital across the world. Last 5, 7, 8 years have been phenomenal for some of these hedge funds, barring 1 or 2 years of drawdown. But if we take a horizon of few years, they are able to generate double-digit returns with very low volatility. So that's a space where we are also very positive that a part of allocation should be uh, given to such funds from diversification standpoint. Few other points where we see a lot of interest from resident Indian families is because hard real estate is very close to Indian families, not just in India, outside India as well. So we a lot of interest in terms of buying properties in Middle East, in Europe, and in London. So there is a lot of money, which is going in terms of buying properties. There are restrictions in terms of leverage and in terms of loan, which I'm sure my colleagues will cover. But yes, properties and deposits are another segment where some of the LRS remittances are being used. Last point here on the slide is citizenship. There are investment routes available through which residents are gaining citizenship of other countries. One of the most talked about or very famous program that US run, which is called EB-5, is known to everyone, where you could make an investment into a property which is generating employment in US, because of which over a period of time you are eligible for citizenship in US. So there are multiple programs that most of the countries, including US, runs, through which you can gain citizenship of such countries. So that's another segment where we see a couple of our clients allocating capital. So these are some of the asset classes or instruments we see that capital is being allocated. On the next slide, we have just put out the canvas in terms of, if one were to invest outside, how can they make that investment outside India, right? What are the different, how advice or allocation can be made? One simple way is to, you can open a broking account outside India through which you can make these global investments. But obviously, there will be restrictions in terms of taxes, in terms of which instrument, in terms of operational aspects, in terms of price efficiency. So there are some restrictions around understanding security, and access to some of these securities will be there. Second option is dealing with a private bank. Now that is an interesting option, but most of the global private bank that we see, they generally tend to service clients those come up with 5 million or above tick size. Even though families and clients in India will have the capacity to remit a much larger amount, but because of the capital controls put in place by the government, it is very restrictive, and it takes a couple of years before such a pot is created. Hence, we see that there is a lot of under servicing done by private banks to most of the clients globally, if the ticket size is anywhere less than $5 to $10 million. But that's the second way in terms of allocating capital outside and getting access to some of these boutique managers, structured products, and other instruments. What we have done at Avendus is we have created a platform in Singapore. We have a team sitting in Singapore who runs our offshore desk, and they advise private banking like experience at a very low threshold. So these are different ways one can do directly, but we suggest that you should consult your advisor in terms of investing both in India and outside India. So I think these were the few things that I thought of covering. I'll just maybe pass it on to Suraj to take us to the detailed slide of what are the different rules and limits available to us.
Sure. Thanks so much, Saurabh. I think that was a great coverage. Good afternoon, everyone. Uh, I'm going to just sort of, like Saurabh mentioned, right, everyone, there is low allocation, so there is need for a greater degree of allocation there, and, in terms of timing also, right? Just going to double click it to make it broader, uh, not just covering, what you could do through Avendus, but also if you choose to do individually, what is possible, what is not, so that you have the entire gamut. And I'm also going to spend a little bit of time on, investing in an asset class, which is property, which a lot of people still like to do. But it's important to know from a tax standpoint, because, that is a cost. And from a regulation standpoint, what is important or not. We can go to the next slide. So from what RBI really wants, and this is for individuals, okay? Some of you all may have capital sitting in an entity or a company. We'll come to that. But RBI essentially said that you have an annual limit of 250,000 US dollar equivalent, which you can allocate. You can invest. You can invest in, some of those instruments, which is largely listed outside, which is what we call portfolio. Or you could invest in setting up your own entity, as long as it is a bona fide business. Uh, they don't want individuals to create any structures that have, a layered sort of impact, right? So once you've created an entity offsite, that entity cannot create a further structure of more than 10% ownership. And that's where, I think what Saurabh mentioned, the Avendus platform will come into play. The Singapore structure where it's regulated, etc., that makes it easier for you to get into that. And what is also allowed is investment in regulated funds. While you see that approval bucket there, these approvals very rarely come through. So if you're looking at investing in any of these corner case countries, it will not come through, or even doing more than 250K as an individual. From an India standpoint, RBI feels it's already high. A lot of you may feel it is low, but RBI is looking at India as a mass to say 250K is high. What is not possible at all, right? And that is also important to know is that if you want to invest again a listed company that is in gaming or gambling or real estate, you could do that. But any venture that is unlisted into these three categories, right? Gambling, real estate, which means buying, selling property, not a development arm. You could invest in development, construction things. And the third one is important that, as individuals, RBI doesn't expect or doesn't want individuals to set up entities to do portfolio investments or to just do anything related to financial services. Which brings back to the point that if you really want to allocate capital, it is simpler and better to do it through a regulated fund or through a structure like what Avendus has, and not try to create it on your own, because that's what the regulations also don't allow. We can go to the next slide. So, slight bit of jargon you will keep hearing, but I'll sort of demystify it for you, right? Again, at an individual level, there are two modes. One is known as, it's a cricket term, I like to say ODI, but it's more like overseas direct investment. And anything that is more portfolio like, RBI calls it overseas portfolio investment. Portfolio is simpler to understand that you could invest in listed foreign shares, all the Facebook, Apple, Google, Nvidia, you could do directly from here. As long as you own less than 10% of listed equity, that is okay. Or you could invest your LRS limit into regulated funds. All of that is what RBI treats at OPI, which is simpler to just send money directly or through a platform and you could invest. Anything that you do in the unlisted space or in a listed space, you end up getting more than 10% is where the paperwork, compliance, there are some prerequisites on valuation, etc., that need to do. And that gets categorized as overseas direct investment or ODI. Now, when you look at both, this question often comes that can we invest in bonds, some fixed income things, etc., or some cap tables, you would have startup opportunities, etc., when you're doing direct. Unfortunately, for direct, there is no scope or no window left for doing anything which is in the nature of debt. There is no, it is just not allowed in whether as ODI or OPI. You're not able to do any direct debt kind of thing, right? And you will have to necessarily follow a structure of doing it either through a regulated fund or someone mirroring that structure, but you're not allowed to do it. And same for, convertible notes, safe notes. If some startup, a lot of people have access to US, sometimes other Singapore entities where your instrument is not equity, you are prohibited from making that investment. There's no enabler or there is no corner case exception for it as well in the law. Go to the next slide. Happy to take questions. I don't know if in chat or whatever, I'll address them, but I'll just try to complete everything and we can take questions toward the end. Now, there are three ways in which we've divided this, right? This slide is really saying that if you're investing in an entity, which is not a financial services entity, which means could be a business entity, could be an entity doing a project, could be real estate development. As an individual, if you see all the greens there, the categories might change whether in listed or unlisted, but if you're investing up to 250K in an entity that is in a bona fide business and not in financial services, you're allowed to do. If it's listed and less than 10, the paperwork is simpler and it goes in OPI. If you see the last row, everything else, even if you do one share in an unlisted entity, which is a startup or which is not a regulated fund, all of that will go as ODI with some bit of friction on paperwork compliance, but generally it is all permitted. The only caveat being that the entity that you invest, if it's listed, unlisted, or if you have control, it can't have a step down subsidiary underneath it. But that is allowed. Now, on the next slide, we have if you want to invest in a financial services, and a lot of family offices, individual things that I'll do my own Dubai, Singapore entity, and I will sort of use that. I'll create an account and do the markets. It is important to see that none of it is permitted. So you can't invest in an entity to do financial services. You can't even have any large listed entity exposure, which is doing that as an individual. It is just not permitted. What is permitted is you could invest in a Bank of America or a listed financial services entity as OPI, which is less than 10, right? Because you are not really doing that business. It is listed and you are taking a small exposure within your 250K. But you can't do control deals or you can't invest in an unlisted entity. Uh, the situations here is, of course, nothing stops Indians from, if you inherit this from a relative, that is permitted. Or if you are working for a company which is into, any of these banking, financial services or other things, you could get ESOP or management shares or sweat equity, right? So those are things where RBI said that you're not really investing, you are getting it against sweat or time or through inheritance. But everything else is so generally in financial services prohibited unless it is listed and less than 10%. We could go to the next slide. Now the whole change, right? And this is what the government is encouraging. IFSC is our gift city. Uh, Here, if you see financial services, everything is a green, right? You can do unlisted, you can do listed with control, and of course, the funds in the gift city that are now being set up, all of that individual can invest up to their LRS limit. The only caveat being banking and insurance currently is, held for residents in Gift City. But apart from that, you're allowed to sort of go and make all investments in all possible structures in Gift City. Can move ahead. Uh, Now, this slide, we are trying to say that if you are a person, you're a professional, you are working, and you want to get shares through either sweat equity, ESOPs, or management shares, for these three categories, there are no restrictions on sectors and there are no restrictions on listed or unlisted or what degree of control or if it has stepped down subsidiaries. So if you're working in India, you're part of a group company of a global entity. And if you get ESOPs, which is consistent, you can't have exceptions for Indian employees and employees elsewhere. So as long as the policy is uniform, it is globally consistent, and you are an employee, right? You're not a consultant, you're not someone who's an advisor. You're an employee of a subsidiary or a branch in India. Irrespective of sector, irrespective of control, you can get these shares. The finer point here is also that this remittance that you do, uh, if for any reason, let's say you get shares and you have to pay an exercise price, for this purpose, you can cross your LRS limit. There is no cap here on the 250K. Of course, it will eat up your LRS allocate the quota for the year. But if you need to send more money in a financial year towards exercise of your ESOPs or anything, that is permitted under the route, whether you are an OPI or an ODI. So RBI has just enabled employees to do this. This is what Saurabh's point was also, right? That to get access to some of the products and solutions, uh, there are these things, right? There are funds now which are regulated. All funds in Gift City, which is IFSC, are regulated. And there are funds offshore which are regulated now, either the fund or the fund manager. It is important to see that as a resident individual, which is on the left, you are allowed to do both. You can invest in an offshore fund, and that fund, as I said, it could give you exposure to some of the debt or other class or structured products, etc., which you can't do directly. And listed entities are also permitted to do both offshore and gift city funds. But if your capital sits in a family office entity like a partnership LLP company, those entities can't make offshore investments into funds, right? They can't. They are only allowed and permitted to do allocations into the gift city funds. They can't directly go to a Singapore, Mauritius, or a offshore fund as well. But as residents, you can, and that, as I said, opens up a lot of horizons because we saw all the restrictions so far that what the residents couldn't do. Uh, by having exposure to a regulated structure or a fund, your investment allocation and avenues open up quite significantly. Can go to the next slide. Uh, Now, all of this that I spoke about till now was all to do with resident individuals. Okay. Now, a lot of people feel that, and we all know that the limit for an entity, a corporate entity, is higher. You could make ODI, which is up to, it's not 250K anymore. It's linked to net worth. In fact, you could technically borrow and invest more because you're allowed to do four times of your net worth if you have an entity. And if you're making OPI kind of investments, let's say into Gift City and all, that use case, what we saw on the last slide, you can do 50% of your net worth. So some people feel that by creating an entity or a structure, we can send or hope to send more money. This is permitted up to 4 times, but there are additional riders to this, right? So a lot of times we hear, there is large family in India that, the whole news keeps doing around that they set up their family office outshore, and people want to really see, can we mirror that structure? So as long as I said it's not financial services, it's bona fide, you can invest in an entity through an entity, which means your India arm or Indian entity can invest in an offshore entity, 4x of its net worth. From an entity, you are also allowed to provide debt to the foreign entity as if you own more than 10% of equity, and you can also provide corporate guarantee, stuff like that, right? Individuals can't give debt, individuals can't sort of assume, can't lever or take any obligations there. Entities can. And if you are investing in financial services, there are two additional conditions. The entity that is investing from India should have 3-year profitability track record. And if you are a regulated entity in India, which means your family office entity is a CIC or an NBFC or something of that sort, you need prior approval from the regulator to do this. With this, you are able to then basically from an Indian investing entity create subsidiaries or entities outside to do financial services, etc., which becomes possible. This structure also has use case where, let's say you're a founders who want to own cap tables offshore with subsidiaries in India. Till August of 22, there was a lot of uncertainty around this on whether that is round tripping, etc. The law got changed and it now sort of permits, like we saw earlier, individuals can't have step down subsidiaries. But if you want to end up in a structure that you need step down subsidiaries, you'll have to first set up an entity here, and your offshore entity then can reinvest, including back in India, up to 2 layers. That is fine. This is allowed under the ODI regulations. The big difference between what corporates can do and what individuals, especially portfolio, is that you need to bring back. So whatever goes under ODI and which is not portfolio investment, the money has to come back to India. But whatever is more OPI and portfolio investments under LRS, that money can sort of keep recycling, and as long as it is reinvested and not lying idle for 180 days, it can you can continue to deploy the base corpus as well as any profits and gains that you make out of it back into the offshore region. It need not be bought back. I think the next one is a little critical one because everyone is excited when it comes to returns, products, money, but people often miss some very basic things, right? We are a country which likes a little bit of friction on paperwork and all, and exchange control laws. These are all designed to avoid the money launderers, but it also applies to genuine cases. What is important is that when you do an OPI, it's straightforward, right? You just go to the bank and you can send money to your own account, or you can send money for all the portfolio-ish investments, right, which is less than 10% of equity, or investing in a fund also, right, like the vendor structure. But if you're investing in something that is more ODI or more like in an unlisted space or in a startup or somewhere else, right, it is important for you to first do some administrative things. You have to go to the bank and get yourself a UIN number allotted. If there are multiple, let's say everyone on this call decides to do a startup, Trisha is doing a startup in US and we all want to invest there. We all will have to have one common banker, and that sometimes creates issues, right? Because people will have different banks. But today, the way the monitoring is that we will all have to be onboarded by a common bank to be able to send money to one startup from India, because the tracking for RBI is through one common bank. And we can, of course, not invest in anything restricted. The government, to some extent, tries to discourage investments, and they've put in a TCS, which is a tax collection and store. There's some capital that gets locked. Anything for investments that is more than 7 lakhs, there is a 20% amount that is withheld. You get a credit out of it, but it is sort of blocked for the time being. It can be offset against your advanced taxes, etc. But that needs to be factored. And for anything that is non-portfolio, you also need to get a CA to give you a valuation report, because RBI is tracking through the banks that you're doing things legitimately, you're not overpaying, so on and so forth, right? So this has to fall in place. It typically takes a week, 10 days to get this, and only then you can send money legitimately to the purpose that you are doing. Once you are invested, there is a requirement to file a statistical report with RBI. Again, we see a lot of people, family office missing it because it's only statistics. So again, no one is chasing, but there are consequences if you don't file. This is due end of December for every financial year, and you have to report statistically of the key sort of performance of the entity that you are there. It's called an APR or an annual performance report. And the second but significant thing is all residents also have to disclose all foreign assets in their tax returns. And here also the tax guys are pretty aggressive on if they discover or if they find out through information exchange you have foreign assets and you've not rightly disclosed, they sort of come quite heavily and try to treat it as benami, etc. Right? So a lot of unhappy situations are avoided if you self-disclose and make it easier. Even on exit, as I said, right, the OPI proceeds you could keep recycling. Whatever is in LRS that can keep getting uh, reinvested. If you get access to a very fast moving deal, which means someone is saying you invest again, this is non-portfolio ODI, you will have to stay invested for 1 year, right? So by this, what RBI has also said is it is sort of taking away a little bit of speculation whether you're doing it as an individual or a company. You need door to door 1 year of investment, and there is no exception to this, right? Under automatic route, you just can't exit less than 1 year for non-portfolio investments. And if it's ODI, you need to bring back the money. It has to come back while you can have accounts offshore, etc. But in 90 days, the money has to come back to an India bank account. And if needs to go back, it can go back as within your LRS or ODI, as the case may be. Very important slide, as I said, right? It's not just about getting products access and all, but to also take care of compliances. And then the next slide, we'll talk about allocation to properties. I understand most of you would be financial wealth allocators here. We all fancy owning a UK, UAE property, right? It's sort of in vogue as much. Uh, so within your 250K, right, what individuals can do, you can buy property that is permitted. If the property is expensive beyond what you've done in LRS or what you can, RBI permits you to only jointly own it with a relative. Okay, so you can't jointly own, you can't do a timeshare with a friend or an Airbnb with someone or an entity. The joint ownership condition has to be someone who's your relative, and the RBI definition of relative is slightly narrower than tax. I'm not getting there, but it is important that you don't end up in fractional ownership with non-relatives. That is strictly prohibited. Okay, it's not allowed. Uh, there are avenues for individuals, people, who in the past have had done OPI investments other than ODI. As I said, that money can keep recycling. So you could buy properties, and this property would also apply to all your immigration properties, right? Where the thresholds are higher. So all income or sales proceeds from your past OPIs can get invested. And if you are a foreign exchange earner or an exporter, you have a resident foreign currency account. Balances there are over and above your LRS, right? For property buying, you could use these, dip into these two sources to buy. Uh, there is sometimes you will end up with property you could inherit, just like we saw in shares, that is possible. You could inherit from a resident and a non-resident. However, the law again here, there is no, India doesn't permit non-resident relatives also to gift you properties, right? So only inheritance is allowed. If someone outside wants to gift you property, including your relative, you have a brother, family, someone who wants to give you a house, that goes in approval route. It is not permitted under automatic. Only if you have someone within India, you buy a property and you want to gift it to your family, brother, sister, parents, children. That is the only thing that is permitted. And of course, people sometimes want some long stay arrangements, etc. If you want to take something on lease, this also got clarified that as long as the lease tenure is 5 years, you can get that property on lease and you can send money through LRS towards security deposit and lease rentals, right? Anything that has, the contractual tenure beyond 5 years is again not permitted or possible. All right, I have just one or two slides and then we can open to Q&A. We already covered this tax, so there will be TCS. There will be a lot of disclosures. There are specific schedules in your tax returns. Your accountants might look at it, but you should know there is this FA schedule, which I spoke about on every foreign asset you own, you have to disclose. And there are separate schedules now that track income from foreign assets and any tax reliefs that you are claiming. and any gains that you make on capital gains, etc. It's all tracked, and the whole sort of faceless and the digitized thing now also map schedule wise. If what you've reported as income also should sort of tie up with each specific schedule where it needs to be disclosed. Sometimes you will suffer tax withholding, etc. Just like TDS in India, some of these products or investments will give rise to tax deductions offshore. And to be able to claim that, there is some bit of administration. There is a specific form number 67. You have to file it, and only then you get tax credit, right? If you miss filing that, the Indian guys will not give you tax credits. All right. I think that sort of concludes the discussion from my side. Happy to, pass it back to you, Visha, and if there are questions or something we
Thank
can
you.
take.
Thank you, Suraj. That was very insightful. I request all our participants to post their questions in the chat box at the bottom of your screen. We have a few questions that have come in. I think I'll start with the first one. Saurabh, I think this one you can take it. Is setting up a family investment fund allowed? And if so, what are the requirements?
So it is not permissible. The only way which is possible is via Gift City. But as we understand, Gift City has a regulator called IFSCA, and they have not given any final approval for setting up of a family office. So it is not under the automatic route outside Gift City. Gift City is the only jurisdiction under which you could create a family office fund, but the regulator is not giving approval. If you were to set up a family office outside of Gift City, which may be Singapore, maybe Middle East, or any other country, then first you need to obtain approval from RBI, and then post that, you could set up a family office.
Okay, thanks. I think maybe Suraj, you can throw some light on this. Is there any TCS implication on an ODI investment through LRS? I think that you partially.
Yes,
Yeah.
anything under LRS beyond 7 lakhs for investments, there's a 20% TCS.
Saurabh, I'll come back to you again. So if there is an investment in the Gift City, through the Gift City route, and that Gift City investment matures, will the reinvestment of the same corpus be treated under the LRS limit again?
No. So once you have remitted money under LRS route to Gift City or maybe outside Gift City, and you plan to either redeem that money or the money investment has matured, you could retain that proceed outside India. But that proceed, if you're taking it in a bank account, that proceed must be utilized or reutilized for investment purpose within 180 days. If these proceeds are not utilized within 180 days, then you need to bring this back in India. Otherwise, you could reinvest always.
There is a specific question on investment vehicles or I don't know products. Saurabh, again, I'll direct this to you. Can you recommend a low-cost private credit fund that one can easily invest in through the LRS route? I don't know if you want to take any of the specific product-related questions here.
Uh, so there are many, but see, like in India, we have mutual funds through which we could simply file form or do the documentation and get investments. Outside India, if you were to make any investment either into fund or into any other security, you need to first have a custody account. So there are ways through which you could access some of these funds, maybe from Carlyle, maybe from KKR, maybe from other large credit managers. But first, we need to secure allocation. We have a platform through which we could provide access to some of those funds by large institutions. Those are being managed by large institutions using our Singapore desk. But yes, generally, there will be some cost, which is the management fee that the fund will be charging. But outside of that, there is very limit cost that you have to kind of absorb.
Got it. Suraj, I think you can take this question because you mentioned this in your presentation as well. What do you exactly mean by a step-down subsidiary?
Okay, so step-down subsidiary essentially means that once you set up an entity, let's say from India, you set up an entity A offshore. If that entity A offshore is further investing in any other entity and owns more than 10%, okay, not 50, but 10%, that entity is treated as a step down subsidiary. So it's like a second layer in the structure.
Thank you. Um, okay, I can, Ashwini, I think you can come in over here. There is again a question on LRS limits. So this one as an example, both me and my sister are resident Indians. Remittance is done within LRS limits. Can she gift me for buying a house abroad, or is there a gift tax?
So a resident Indian cannot gift LRS funds to another resident Indian for any purpose. But having said that, you, as Suraj said earlier, you can jointly buy the house together in both names.
Got it. Suraj, maybe you can, again quickly summarize, because there are a couple of questions on this as well again.
Sure.
What are the best options for a company that is domiciled in India to make investments in foreign markets?
So I won't have a product lens for sure, but if your company or you have an entity in India, uh, your the way you can allocate more capital is through a gift city fund that is regulated, something that, let's say, Avendus, etc. would have, and thereon you can build the products from there. If you have 3-year profitability track record, you can try to set up your own sort of arm offshore and get the necessary licenses, etc., to do financial services investments activities as per that country. Uh, these are the two ways where you could take, larger capital outside for investments. If it's for business, again, then it's straightforward. You could take up to 4x of your net worth.
Okay, and just on a related note, just to
Yes.
clarify, is the ODI, OPI option available for Indian companies that do not have business operations overseas?
Yeah, it is. I mean, so as I said, OPI is technically, or if we just look at OPI, is only for investment in gift city. For a company, there is no other use case of an OPI. It's essentially for doing investment into a gift city fund. ODI is available. You could set up your first entity there, but that entity, if it's purely investing, will become financial services. So you need to fulfill the additional conditions, right? You can't like just set up an entity to invest. That might need some local country licenses, regulations to do, and in India also you'll have to fulfill the profitability track record and financial services approval. But you can start. I mean, there is no restriction there.
You. Saurabh, maybe you can take this one. Can I invest in bonds of listed Indian subsidiaries through the LRS?
Yes, it is allowed as long as you are buying from secondary market and not from the primary market. Yes, one could do that. Maybe another best way is because if you were to invest into any fixed income bond outside India, the minimum ticket size or minimum investment in each bond is 200,000 US dollars. So if one were to create a basket when considering the LRS limit, which is there in India, it is very difficult to create a diversified basket. So the way we suggest is you invest into a fund which has a basket of bonds. Maybe these are bonds issued by subsidiaries of Indian companies, because many of these Indian companies have their operating businesses outside, and these operating businesses are in the need of capital, hence they issue bonds. So yes, you could do that, but our suggestion will be to invest in a fund structure which gives you access to some of these underlying bonds.
Just as a follow-on to that one, when does it run the risk of coming under round tripping?
So as long as there are multiple layers, and you should obviously consult with your legal advisor as well. It doesn't run the risk of round tripping as long as you're not investing into bonds issued by Indian entities, because Indian entities also issue bonds in dollar denominated papers. As long as you're not investing into these bonds and you're only investing into funds, those funds are having access to bonds issued by subsidiaries or operating businesses, it is highly likely that it should not be construed as round tripping.
And Saurabh, if you can also throw some light on the taxation, does this come under the LTCG, STCG under the new rules?
Yeah, so anything which is less than 2 years is added in the income and tax at marginal rate. If it is more than 2 years, then it is taxed at long term, which is 2.5%. So the taxation is fairly simple now. There used to be indexation benefit, which is all taken away in the last budget.
Um, in terms of, so I can maybe Suraj can answer this one. So if you are remitting, with regards to remitting through one bank account to an unlisted company, if say a US startup is raising capital for 10 different investors in India, practically, do they all need to open an account with a particular bank and then remit?
Yeah, unfortunately, the systems at the bank level are not evolved enough. So the first remittance, and maybe I read the question that investors may not know, but the company would, or whoever is sort of creating that syndicate. Um, the bank that creates the UIN, the unique identifier, by whoever remitted first, right? Because it will get created there. For tracking today, it is essential to go through the same bank. Of course, as you know, the technology, this is not a legal requirement. This is a practical sort of, let's say, technological, uh, thing until banks sort of are able to cross-pollinate their data and permit that. As of date, this is a practical issue that you have to sort of get onboarded in that bank and then send through that bank. This is not coming from law. This is practice.
Got it. Um, Another question is around hedging the currency risk. Saurabh, maybe you want to take this. Is it possible to hedge the currency risk of your global investments? And if yes, then what are the ways to do this?
So under the LRS regulation, we are not allowed to take any or create any position in currency. That's straight answer. But if you really look at it, if you are using LRS limit and investing outside India, then you are benefiting because of the currency, because you are buying dollars today and you will sell dollars later. So currency depreciation, if INR were to depreciate going forward, it only helps you. It doesn't deteriorate your investment. Hence, we don't suggest in terms of hedging currency. But if you were to hedge your India portfolio or India corpus using LRS limit, then it is not permissible. If you were to create some currency position, then you might as well want to create on Indian listed rupee derivatives.
Okay. Saurabh, one more question for you. One of our participants has requested if you can elaborate more on the Avendus offshore structure. Is it available only for individuals? You can just.
So I can, definitely give 2 cents on it, and maybe we can connect one on one, or maybe with your relationship manager to discuss more in detail. But to give 2 cents around that is we run two set of businesses from our Singapore office. One is the advisory proposition, which is very similar to what we do in India, wherein we will understand your portfolio, we will understand your profile, and basis the profile and the risk metrics that we will have, we will create a portfolio which will be diversified across different asset classes and different countries. So it is more like an NDPMS platform, that practice of an NDPMS platform that we run from a Singapore office, where we do complete advisory across the markets. We don't invest into securities directly. We choose managers who we feel, where we have the highest conviction and we feel will be able to do justice to the allocation. So that's the advisory proposition that we run from our Singapore office. Second proposition that we run is product led, where we have the most conviction. So we, like I mentioned in my allocation slide, that fixed income is a space where we are very excited. Hedge fund is the space where we are extremely excited. Equity, global diversified equity is also the space that we want to allocate capital both in US and in Japan. So yes, we also come out with products where we have most conviction. That's more product led. If you were to buy a specific strategy, buy a specific portfolio allocation, and we run a more holistic portfolio level approach through our advisory platform, and we'll be more than happy to kind of discuss that at a length.
Thank you. Ashwini, I think you can come in over here. There is one question. Can an Indian settle a trust outside India using LRS funds?
Tusha, I think I will redirect that to Suraj, the expert.
Okay. My general answer will be no. Setting up of a trust, is generally not allowed. You will need to sort of involve a non-resident relative, etc., at least in the creation of that, because it is not an entity typically, and it doesn't give you any equity or any instrument in return, right? So a technicalish answer would be no. A practical answer would be case to case basis. There are some structuring solutions that can be done, but will require sort of more fact-driven indulgence and solutioning.
Thank you, Suraj.
Yeah. Suraj, one more question. It was said that an investor cannot invest in any entity outside India which is engaged in real estate business. However, if there is an entity which has purchased a residential property for leasing out and not for trading, and it's not with the intention of immediately selling, then can you still invest in such an entity?
So yeah, what is real estate? Really, even if you're, let's say, if you buy a completed property for leasing, that is strictly not real estate. What the government doesn't want is buying, selling of real estate or strata, etc. If you're buying and leasing, you're technically like an hospitality. That's why I'm saying, let's say you buy an apartment and put it on Airbnb. That should generally be okay, and it will get classified as hospitality or a business sort of venture. Uh, but if you have portfolio and if you keep churning that portfolio after some time, that would be real estate, which is not permitted.
Got it. I'm not sure if you or Saurabh who will be the best person to answer this, so I'm just going to ask this question. So, for a society that is registered under the Act of 1860, can they make investments in GIFT City structures as per the latest FEMA guidelines?
No, they're not allowed.
They're not
And
allowed.
I would just add that maybe the society itself, by the society bylaws, would not be allowed. So before looking at FEMA, even the society will itself sort of prohibit, they're only allowed a particular class of, not-for-profit investments, and they can't do for-profit investments.
Great. Ashwini, Suraj, again, one of you can answer this one. If a trust was created with when the sole beneficiary is a resident, however, now on distribution of corpus shares of a listed company, let's say, the beneficiary becomes an NRI, can he still receive the distribution?
Should I take that, Ashwini? You want to respond?
No, that's fine. If required, I'll add it.
So this is, shares that someone puts in a trust and the beneficiary is India. When the trust sells, the trust will pay tax. The money will hit the beneficiary's India account as a distribution. From that account, depending on what the beneficiary status is, that person can take either LRS, which is 250K, or if the person by then becomes non-resident, can take $1 million outside, right? There is no other way that the trust will sort of enlarge the limit which is otherwise available to the beneficiary. Ashwini,
Sorry.
would you like to add to it?
So I was actually unclear about the question. Is the trust set up in India or outside India? Okay, that is one. And I'm assuming, as Suraj said, that the trust was set up in India. And Tusha, you are on mute.
Yeah, sorry.
Yeah. So I'm assuming the trust was set up in India. So in case the trust was set up when the person was already a non-resident Indian, then that $1 million limit is not permissible if the money is distributed from a trust. Okay, there are under regulations issued in July 2015. If a trust distributes funds to an NRI when the beneficiary was already NRI when the trust was created, the limit is $250,000 and not $1 million. But if after the settlement of the trust, the status of a person beneficiary changes from resident to non-resident, then $1 million is permissible.
Yeah, I would concur with that. Yes.
Okay. Again, Ashwini, maybe you can take this one. How are some of the big families setting up family offices outside India? What are the regulatory implications if one wants to set up a family office outside of India?
So there is not one structure which people are using, but primarily the use case is that families are doing two things. One, they are setting up a family office in India and then taking an approval to set up a family office outside India. As Suraj and Saurabh had covered earlier, if they set up under Gift City, then OPI is permitted. Under automatic route. Otherwise, in all other cases, it will be under approval route. The second case is that a person becomes who is a resident Indian and owns assets in India. He becomes a non-resident and then sells his assets to an Indian relative, then remits the funds to outside India to set up a family office. Those are the only two routes. But Suraj, if you want to add to that, please do.
No, that's comprehensive answer. I think those are the only routes. Of course, there is, structuring, and each family has some specific nuance and cases that can add, but by and large, that is the framework within which this can be done.
Saurabh, one more question for you. In terms of investment in optionally convertible redeemable preference shares issued by a foreign company, does the RBI treat this investment as a debt or investment or an equity investment? And is there any RBI approval required in case if it is a debt instrument?
I'm not sure if this will be allowed, not allowed. Suraj, will you be able to
No,
throw some
it will
light
be debt. It will be debt. I think this is debt. Anything that there's a definition of equity now, which has to be equity, CCDs, compulsory instruments. So
Correct.
anything that is not that would be debt.
Got it.
So there's an interesting structuring possibility also there. Okay. While CCPS is what will be classified as non-debt, okay, and OCPS will be or OCDs will be classified as debt, there are other options possible. So in case somebody wants to engage in things, they can reach out to us and we can facilitate a discussion with Suraj.
Great. Thank you. Ashwini, maybe you can answer this one also. If a resident individual gifts his child, who is an NRI, a real estate property, would it come under the LRS limit?
So the first cut is I will like to divide that. If the property is agricultural property or plantation property, then the gift is not permissible. Okay. If it is any other type of property, then gift has to be within the limit of LRS.
Saurabh, maybe you can come in over here. Considering that IFCA is not granting approval to FIFs, what is the next best alternative for families to utilize the gift platform?
I think the next best option, which is available to both individuals and as well as companies. And when I say companies, companies means both, right? Listed or unlisted company, and unlisted also, registered partnership or LLP or, any private limited company. AIF is the best available options. And right now, there are many AIFs, those are already live and are raising capital from Indian investors in terms of investing outside. Couple of such AIFs are already there on our platform, but that is the next best option available. Obviously, we can't give it a form and shape of a family investment fund, but it definitely meets the objective of diversifying and allocating capital to global markets. And outside of individuals, for companies, at least for unlisted companies, this is the best route available at this point in time to diversify portfolio outside Indian borders.
Is the bookkeeping period longer for tax purposes if you've invested abroad, in case there are any queries from the IT department?
Okay, I can take that. Yeah, unfortunately, it's the longest. These guys have up to, I think for individuals, they can go up to 16 years, which is like really long. But then they found people with, capital formation with the not the most cleanest ways, and they've kept that thing. Practically, beyond 7, 8 years, nothing generally happens. But legally, they could go 16 years for individuals.
Got it. Great. I think that pretty much brings us to the end of the Q&A. Yeah, so Ashwini, I think I'd request you to put in some closing remarks for our participants today.
Great. Thank you, Trisha. Thanks, Suraj. Thanks, Rupali and Saurabh, for being there. I think it was quite an enlightening session. This FEMA and investing outside India, LRS, ODI, is a quagmire of regulations, and the August 2022 regulations have not really eased the matters, even though the intent was to ease the matters, but they have actually compounded in my view, they have compounded the matters by having three different sets of documents, rules, regulations, and directions. And so it is best to take advice, and specific advice always helps. Each individual's case is different, each family's requirements are different. And what we have not covered in this webinar today is the effect of DTAAs. Okay, and that is something which is, again, there are a whole lot of structuring possibilities over there. So that is something which one needs to consider and take proper advice before doing anything outside India. Additionally, there are a lot of clients we find are trying to set up base outside India and becoming NRIs by taking golden visas and or PRs and all. That also requires you to change and closely examine the structures. One of the issues which I found, and maybe Suraj can throw more light on that, is that what to do with the LRS funds once a person becomes NRI. Should he keep them separate, or should he keep them? Is he allowed to intermingle those funds with the $1 million route which is available to NRIs? And can both of these be intermingled with the income that he generates outside India? So those are interesting things which make life interesting for practitioners like Suraj and Rupali and us. So my always advice is, please take specific advice, approach people like Suraj, and then only take any decisions to move outside India. Thank you from my side to everybody who's been a part, and I hope you all enjoyed this as much as we enjoyed presenting.
Yeah. Thank you everyone for joining and for this very active participation. We hope to see you in the next edition of our Bespoke series. Thank you so much.